The general principles of financial planning domain represents approximately 15% of the CFP certification examination and serves as the core framework for comprehensive financial planning. This domain introduces candidates to the foundational principles required to evaluate a client's financial condition, establish goals, and design integrated financial solutions. Topics include the financial planning process, financial statement analysis, cash flow management, financing strategies, economic concepts, time value of money calculations, education planning, and tax-efficient gifting strategies. These principles help financial planners build a structured approach to client engagement while supporting informed financial decision-making. Mastery of these concepts enables professionals to create personalized strategies that align financial resources with long-term personal and financial objectives. The financial planning process is the foundation of professional financial advice and provides a structured method for working with clients. The process generally includes establishing client relationships, gathering financial information, identifying goals, analyzing financial conditions, developing recommendations, implementing strategies, and monitoring progress over time. CFP professionals must understand how to apply this process consistently while adapting recommendations to individual client needs and circumstances. Effective planning requires both technical expertise and communication skills because planners must clearly explain strategies, risks, and alternatives. The planning process also emphasizes ongoing review and adjustment, recognizing that financial goals and economic conditions evolve over time and require continuous evaluation to maintain long-term financial success. Financial statements are essential analytical tools used to evaluate a client's financial condition and support informed planning decisions. CFP candidates must understand how to prepare, interpret, and analyze balance sheets, cash flow statements, and income statements. These statements help planners assess assets, liabilities, income sources, expenses, liquidity, and net worth. By reviewing financial statements, planners can identify strengths, weaknesses, and opportunities for improvement within a client's financial situation. Accurate financial analysis supports recommendations involving budgeting, investment planning, debt reduction, retirement preparation, and risk management. Understanding financial statements also enables planners to measure progress toward financial goals and communicate financial information clearly and effectively to clients during the planning process. Cash flow management and debt management are critical components of financial stability and long-term wealth accumulation. Financial planners help clients analyze spending patterns, establish budgets, maintain emergency reserves, and improve savings behavior. Effective cash flow management ensures that clients can meet current obligations while allocating resources toward future goals such as retirement, education, or investment growth. Financing strategies involve evaluating borrowing options, managing debt repayment, and understanding the costs and risks associated with leverage. CFP professionals must assess mortgage structures, consumer debt, refinancing opportunities, and credit management strategies. Responsible debt management reduces financial stress, improves financial flexibility, and strengthens a client's overall financial health and long-term financial sustainability. Economic concepts play a significant role in financial planning because economic conditions directly influence investment performance, interest rates, inflation, employment, and consumer behavior. CFP candidates must understand macroeconomic and microeconomic principles, including fiscal policy, monetary policy, supply and demand, inflation, and economic cycles. These concepts help financial planners evaluate how changing economic environments affect client financial plans and investment strategies. For example, inflation may reduce purchasing power, while rising interest rates can affect borrowing costs and bond valuations. Understanding economic trends enables planners to make informed recommendations regarding savings, investments, debt management, and retirement planning, while helping clients navigate uncertain financial conditions and market volatility. Time value of money concepts and calculations are fundamental mathematical tools within financial planning. These calculations recognize that money available today has greater value than the same amount received in the future due to its earning potential. CFP professionals use time value of money principles to evaluate loans, investments, retirement savings, education funding, and insurance needs. Common calculations include present value, future value, annuities, loan amortization, and internal rate of return. Financial planners must understand how interest rates, compounding frequency, and investment duration affect financial outcomes. Mastery of these calculations allows planners to compare alternatives accurately and demonstrate how consistent saving and investing can significantly influence long-term financial success. Education planning is another important component of the general principles domain because rising education costs create significant financial challenges for families. CFP professionals help clients estimate future education expenses through education needs analysis and recommend strategies to accumulate sufficient funding. Candidates must understand the characteristics, tax treatment, contribution rules, and flexibility of various education savings vehicles, such as 529 plans, Coverdell education savings accounts, custodial accounts, and prepaid tuition programs. Education funding strategies may also involve scholarships, grants, student loans, and financial aid planning. Effective education planning balances educational goals with other financial priorities while minimizing future debt burdens and preserving long-term financial stability for both students and families. Gift and income tax strategies complete this domain by emphasizing tax-efficient wealth management and transfer planning. CFP professionals must understand how taxes influence financial decisions involving investments, gifts, education funding, and income allocation. Strategies may include annual gifting exclusions, income shifting, tax deductions, tax credits, and coordinated family planning approaches designed to reduce overall tax liability.